Right, y'all. So y'all already know what y'all here for. It's the swing trading masterclass. All right. So moving into this presentation, into this class today, y'all can just already have it in your head, baby. I'm not talking about any time frame that is under the hour. No time frame under the hour. And the only time that I go down to the hourly when I am swing trading is when I am entering and exiting. Not when I'm thinking about entering and exiting, only when I'm entering and exiting do I go down to the hourly. And that is the lowest. I also show y'all on the 2 hour and the 3 hour because I have seen and know of a lot of people who trade on that, but we split in hairs at that point. If do your due diligence on your own to see what you like, right? I think that trading strategies are like snowflakes. Everybody different because everybody thinks differently. So if you are looking at my chart and I'm on the hourly, but when you look at your chart, you're on the 2 hour and you understand that better, guess what? You're right. You're right. I'm still right because that's what I understand. And you're right because that's what you understand. All right. So my biggest thing is when it comes to any sort of trade that you do, you have to know how to read this chart. It begins and it ends there. Anytime somebody asks me, my new thing in the home in the Discord, for those who are watching this recording on YouTube, click the link in the description. Okay, my Discord is my mansion that I have built. And my new thing that I'm going to say when y'all ask me my opinion on a ticker is show me your chart. Because other than that, if I tell you how to get in this trade, the profit is mine. Let's be real, I did the work. The profit is mine. So show me your chart because your chart will be able to tell you. All right. You cannot do any sort of trading without having analyzed that chart on the higher time frame, even if you want to scout. And we have an amazing analyst that is inside of the Discord who is a scalper. I rarely see that man past 30 minutes in the market. After the first 30 minutes, I don't even see him active anymore. He still goes to the daily and the weekly time frames in order to tell him how to play on the 1 minute time frame. There's nothing that you can do, and this is just in life. There's nothing that we can do without knowing the overall picture, and that is very much so here in the market. So we already know that we have there's different time frames that are when we're trading. There's scalping, day trading, swing trading, positional trading. If you're working a 9 to 5, let me. Oh Lord, I'm putting this on YouTube. Am I gonna say this? I mean, if you work in a 9 to 5 and you're paying for a Discord subscription and you're day trading while the analyst is sitting at home and you're sitting on a 9 to 5 job and you lose, but you blame it on the analyst on the call out or slow Wi-Fi or whatever it is, I'm gonna need you to hold that mirror up. It doesn't even make sense. It's impossible to do two jobs at once unless you're ADHD like myself and talented, right? But yeah, I've never seen anyone do two jobs at once. Never seen a surgeon also go into the courthouse. You feel me? You can't be at your 9 to 5 in day trading. Sorry. So guess what? The market provided different time frames for you to be able to trade. Oh my. If you sitting up in somebody's office, whether you want to be there or not, maybe you need to be swing trading. And even better, probably positional trading. A lot of times the things that happens when we're trading is nobody else's fault but yours because you refuse to be realistic. All right. But I also understand that that has to do with social media because you wake up on social media every day and the people that you're following in the financial literacy space are posting that they're making $2, $3, $4,000 a day. Guess what? They're doing it from home. Are you? All right. So to see the move, you got to chart the six, my babies. And so I'm going to briefly show y'all how I will mark off the zone that we are the range. I'll say that we are in on the higher time frames. Okay. And I start off looking on the weekly. Me personally, I start to look on the weekly. I'm going to show y'all how I mark off that range. And that's the only thing that I pay attention to. I'm not looking at anything down below, up above, specifically the range that we are in right now. And once I'm done playing with that, playing inside of that range, hey, or when price is done playing inside of that range, hey, I delete it and pay attention to the next that we're in. All right. So when I'm saying chart the six is just something that I got used to saying with my mentees. Do not disturb. Thanks, Fitty. You the latest. Um, Baby, I keep 6 lines on my chart for the most part. When I'm actively day trading, you're gonna see a couple more, but once I'm done day trading, they leave. And I will show y'all my watch list once we're done with the PowerPoint on the higher time frame, baby. I got 6 lines on that chart and it tells me everything that I need to know. I am one of the analysts who truly believes that supply and demand and support and resistance are two different things. And then you also need to have some retracement levels, right? Because price is never going to go from support straight up to resistance. It's going to pull back somewhere. And that is the retracement. Whether you use the term retracement, pullback, correction, we saying the same thing. We saying the same thing. Don't get too hung up on that, on the language. We saying the same thing. That price didn't go just straight up, right? So to get into that, and if you've heard this before, repetition is key. Repetition is key. I'm going to put this on YouTube so y'all will be able to pause and really read the definitions here. But in Alexandrianism, the law of demand is telling us that the cheaper the price is, the more buyers that you're going to see. It's that simple. The cheaper the price is, the more buyers that you will see. And we are traders, investors first, but all right, trading. We are traders, all right? We buy it low so that we can turn around and sell it high. We already know that. Buy low, sell high. You know that is watered down in your brain, okay? So the law of demand is telling you the more affordable it is, the more that we're going to demand this product. And then what happens? This company has to increase their production. It's like, oh snap, more people are buying me. And so let's just put it in terms that's relatable to us with Wall Street Ben Black. If you knew me, and I got the chat pulled up, I'm watching, so you could put some ones in there if you knew me when I had less than 1,000 followers on Instagram. And around the time when I had less than 1,000 followers on Instagram, less than 500 on Instagram, really, you know what I'm saying? I see those ones coming in. Sean, you were definitely one of the first people to follow me. I was for my mentorship. I was charging $350. I know y'all sick. I know y'all sick when I said that. Sick, I know. $350. I don't have 5,000 or 1,000 followers on Instagram anymore. I wish I would. I wish I would still charge $350 for my mentorship. I had to price it very affordably because there wasn't a lot of demand. There wasn't a lot of demand, right? I'm up against who's safest? Who's the safest to say? I'm up against Wall Street Trapper. All right, with 1,000 followers. I had to price my services affordably to create the demand. All right. The demand came in being the client or being the followers on my platforms. So guess what Wall Street Ben Black did? Increase their prices. All right. Now at the top of the year, I was feeling myself and I still am. All right. And when I said, all right, I'm really done with this. I done built this up. My Discord, the home is being built up. I'm branching out, doing live events. I got the school going, the social media is popping, getting monetized, all of this stuff. I'm feeling myself. I said, hey, today's prices ain't tomorrow or yesterday's prices. And I raised my mentorship from hey, as the demand was coming in, that price was slowly going up. It was 2,000 for the year at the end in 2023. January rolled around and I said, well, I'm kind of really pulling back, especially doing these webinars. You really gonna have to come in here and get me. And my mentorship was priced at $3,000. It was at a high. That was at the highest that it's ever been. That was my resistance level, 3,000. Baby, I didn't have a mentorship sign up for a couple months, and I know y'all on the other side of the screen laughing. I'm okay with that. It was a couple months because the law of supply tells us that the more expensive it is, the more sellers you're going to see. The more expensive the price is, the more it is out of people's range, the more used it is, right? And in this case, when I'm saying used, what did I also do at the top of 2024? I put out a pre-recorded course. Of course, that's going to create less demand, right? For Wall Street Ben Black, because check this, follow with me, stay with me. I had more supply. I wasn't just doing the mentorship. I wasn't just doing group webinars. I had a pre-recorded course. I had a Discord that was growing. I had 2 pre-recorded courses, right? Then it was, I started saying I'm going to go around and do live in-person events. I had excess supply. And that excess supply that I had was more affordable. That's where I messed up at. Hey, catch this, catch this. That's where I messed up at. I put more supply on the market that was more affordable than my big money ticket, right? Which created less demand. So what did Alexandria have to do? What did Wall Street Ben Black have to do? Lower the price. Been popping since. Lowered it back down to what my platform has told me, right? By all the demand, that $2,000, they felt that there was a steal for what they get. All right. Now I know I said I'm gonna go through this, but y'all feel me out? Okay, great example. That was all I needed to see. I'm gonna keep going. Period. All right, so we'll briefly go through this. There's 4 phases of market movements, okay? You're going to see accumulation, then the price will uptrend, then the price will start to distribute, and then the price will downtrend, all right? And when I'm saying the price, but it's the market movers doing it, but we hear smart money, institutions, whatever it is that you want to say, all right? The word accumulate means to gather, and the word distribute means to give away. You shouldn't ever freeze up if you're looking at a chart and if someone asks you, a mentor or whoever asks you, hey, this consolidation that's going on right here, is it accumulation or distribution? Baby, you shouldn't freeze. Don't freeze. You know how to use the word accumulate and you know how to use the word distribute in a sentence. So when we're going back to the law of demand, we understand that that's where the buyers are because we like to buy it when it's low. All right. So if the word accumulate means to gather, again, we like to gather when it's low. So when we're looking at the accumulation and the distribution phases in the market, we will see price trading sideways. It will be consolidating, chopping, trading in a range. Again, we're saying the same thing. All right. Now, truly, okay, you could go on a higher time frame and take a good guess, especially if you understand what overall trend is the market in, right? Like right now, we are in a bull market. So if we pushed, as we have, all the way to highs, we ran up for a year and a half, 2 years, almost, or a year and a half, almost 2 years, and we got to a brand new high, and then price just stopped. It didn't make the new high. It started to consolidate. And it consolidated for days, for weeks, honestly. We can take an educated guess that that is a distribution phase, that is the distribution phase. All right. And if we go back, what happens after the market starts to give back supply? What did we just say with Wall Street Ben Black, right? When there's a lot of supply up there and not a lot of buyers, you got to lower the price, meaning price is going to drop. The next and final phase is the downtrend. And then guess what? Price starts all over again. It begins to consolidate as they are gathering their position again, over and over and over, because history repeats itself in Wall Street. They're black, real black. All right. So I personally love to find me a chart that has some consolidation on it. Okay. I will go looking for a chart that has consolidation with the understanding that I'm probably not going to be able to enter into that trade the next day, maybe not even the next week. Shoot, it might not even be the next month. Swing trading requires patience, but it also requires less time on the chart. I've started to calculate it now, and y'all know I'm not quiet when I hit that. This week, everything over 60%, I think, and we'll look in the Discord. I think everything was over 60%. I'll be able to correct myself in a minute if I'm wrong. I spent 3 hours total working last week to enter into the trades, to observe it for a little bit, make sure I was good, everything was good to go, and then to sell my trades. 3 hours total, 5 figures. I like it. All right. Now, before you sit there and you say, perhaps maybe someone someone on the other side of the screen is saying, well, your experience, you've been doing this for a while. Ah, ah, ah. Gone. One thing I've always done for us, not y'all, but for us, is I get into very affordable swing trades and tell y'all to sit y'all butt in them. Y'all know I'm calling out something that's in the $100 to $200 range, sit in it. And y'all seen it turn into 4 figures. You've seen it turn into 5 figures. All right. It don't take much. It takes patience and a good setup. And that's what we're here to find out today. All right. So the accumulation, when we see it break out, that is when we know, is this accumulation or is this distribution? All right. If it breaks to the upside of the chart, I don't know, Miss Reese. I don't know if you meant, I don't think you meant to send me the screenshot of you screenshotting me. So once price breaks out of the consolidation, that's when we're able to confirm, was it accumulating or distributing? All right. If price broke to the upside, boom, we already know that was accumulation. If it starts to uptrend, what was the step before that? It was accumulation. All right. If price broke to the downside, boom, we understand that that consolidation that was going on was distribution. We need to be trading down. Right. Oh, I do want to say this. So I'm a huge believer that if you know what's there or what should be there, right? Look ahead and you know what should be there. It's so easy to spot it. So something that I have really dug into myself, into y'all, to make sure that you just automatically know is that there's going to be very high probable patterns that we'll see in these accumulation phases. All right. And we also, and again, we understand that the accumulation phase is at demand. All right. In a demand zone. We're going to see double bottoms, triple bottoms, inverted head and shoulders, rounding bottoms. All right. We will see bullish chart patterns in the demand zone. So if we're consolidating and I can look at the chart and understand that it is a low, and I start to see a double bottom being formed, I need to have all eyes on it because I know what I expect to see there. So when I see it forming, I'm getting ready. All right. So the uptrends, this happens very slowly, okay? Now, we will always see that price will retrace, retest these broken ranges, all right? Now, there's a reason for that. I feel like everyone knows that, oh, price is going to retrace, and we've kind of memorized that. But let's talk about why. Why does the price retrace? It's because banks have orders here. They're placing orders in the accumulation phase, right? They're placing their orders or in the accumulation or distribution, and they're getting ready. They're doing it very slowly. So in these phases, the impatient, I don't want to say the uninformed, the impatient novice trader, anytime that they see a little green candle up here at the top of the resistance level, like where there's been a lot of highs, where historically it continues to reject, the impatient novice trader gets into the upside. And then what happens? Price reverses and you get stopped out. Guess who scooped that up? The institutions. There's not an unlimited supply of shares and contracts on the market that we can trade. They need you out of the way. Right? So how many times have you seen it where the market is ranging? You thought it was going to go to the upside. So you get in calls or you go long, whatever it is, whatever financial instrument you're trading, right? You get into the upside and price automatically stops you out and going back down and you get stopped out, right? And you got to sell it. So you're still sitting there watching and you see a big red candle down at support and you're like, oh, okay, I guess I looked at this wrong. You get into the downside, you get in puts, you go short and price shoots back up and it stops you out. And then you be like, well, God dang. So then all of a sudden it's shooting up to the top and then you're saying, oh, okay, I was right the first time. You get into the upside and it stops you out again. You finally give up, walk away, and then you come back and the price ended up breaking to the upside later on. And you get frustrated. Has that ever happened to anyone? Y'all leave it in the chat or put it in the comments. Guess what? That's designed. They just played a game with you and they beat you and you lost. I'm gonna put it like that. Not they beat you, you lost because you refused to be patient. Historically, they are showing you price, they don't want price out of this range. They have historically shown you that. So why are you going to keep doing it? That's not anything that has to do with the chart. That's something that's inside of you. So hold that mirror up. Don't beat yourself up, but hold the mirror up and figure out, why are you so impatient when you could just wait, be late to the party? You think you're going to be able to keep up with the trillionaires and make the same move that they make every single time? No, it'll be a couple of times where you hit that with them and you're going to start to feel yourself. Guess what? You're not JP Morgan. Okay. You're not a hedge fund. Okay. You're a speck in this big old wheel. And that's we are specks in this big old wheel where they allow us to come in and capitalize. All right. This is the game that they allow us to do because they need us in some form. All right. And in the uptrend phase, the way that they need us is to push the price up. Because once the institutions break price out of this range, right? Once they open up, they push those orders out, right? They step back. They can't continue to put their money on the market. This is billions of dollars that they're gathering, right? And so something that I always like to say whenever I'm talking about these phases is, let's humanize it. The people that we're trading against, especially if you're trading option stocks, right? The people that we're trading against, it's their job. They're sitting somewhere in California in a hedge fund office, and one of their clients is Apple. And Apple has 50,000 employees that they need to get a 401k to. Where do you think the shares in the 401k come from? From the hedge funders, the people that we're trading against. It's their job to make sure that you stay out the way so that they can keep their job and keep food on their table. You feel me? Y'all feel what I'm saying? Let me know in the chat. If you're watching on YouTube, let me know in the comments. You have to really understand like who it is that you're trading against, right? So that you can be a little bit more realistic, that you're wishing and praying and you're hoping and swaying. Let it go. Let it go. Stick to the technicals and leave the emotions out. Ain't no emotions when you're playing with trillionaires. All right. However, so back to the orders that they leave down there, right? So if we understand that this is billions of dollars that they're accumulating here, they can't release all those orders at once. So that is why price retraces, because they're coming back for the rest of those orders to repeat the move. They let price come back down, right? Because guess what? The uninformed, impatient trader is not going to wait. They're going to go ahead and sell. Guess who scooped them up again? Thank you. Get to keep my job for another quarter. You feel me? So, of course, it's going to retrace because they can't release all their orders at once. If they did, price would skyrocket. It's a lot of money. It would skyrocket, okay? So they're going to capitalize on us coming in, crowd psychology, and understanding that, oh, snap, price is going up. Look, this person saying they're getting, this person saying they're getting, I'm not finna miss it. I'm going to get in. Sounds like NVIDIA, okay? All right? They're going to capitalize on that. When we enter into the distribution phase, what they're capitalizing on is your greed. I'm saying yours because I got rid of my greed. They're capitalizing on your greed that you still want price to push to the upside. Baby, price can't keep going up because then you're not going to be able to afford it. It has to come down so that you can get it affordably. Oh, snap, y'all. Rich is in the building. Man, if y'all don't know who Rich Greed is, make sure that y'all learn Bid Your Ask Off. I'll drop the link here in the chat. That man is probably the most litest, so I feel very special that you're here. That's lit. But yes, look at him, got me distracted. I was doing so well. All right, so let's get into these patterns that we'll look at. There's two types. Price only do three things. It go up, it go down, it consolidate. All right, but let's still look at these. We have our trend continues after it bases, because that's actually the technical term for consolidation is a base, it's basing. But anyways, so the trend will continue after it bases, or the trend will reverse after it bases. Still very important to know these and to have them separated, categorized in your mind, whatever. All right, so let's look at the trend continuing base. So what we're gonna see is the initial was a downtrend. And then after it downtrended and it came here, Biddy, thank you. After it dropped, right, we got this downtrend, it based, and then we see that it broke out of the consolidation. So this is letting us know, okay, this was a in the distribution phase, which we understand as highs, all right, a supply zone, all right, so it dropped, retraced, okay, and then dropped again. So this is a drop base drop. That's how we say it. It's a drop, it based, and it dropped. It continued to trend. But let's really dissect this and break this down, okay? Because I don't want y'all to walk away and be like, oh man, it's a drop base drop. It's a rally base. No. Let's break this down. Right. So, couple things here. It's the volume for me. Candlesticks and volume, that's me. That's my strategy. It begins and ends with price and making sure that volume matches it. So let's look at this example here. As price was dropping, we see that the volume, come on, mouse, we see that the volume was decreasing. The volume started to decrease, which would be my first indication here that once it came back to this zone, which when price was above it, it was acting as support. But anyways, when price came back into this zone, that it was gonna stop, that it wasn't just gonna blast through it. Why? Because the volume decreased, right? So before we move on, let's break down volume. What is volume? It is not the amount of people that are trading. It's not, my babies. It's not. It's not the amount of people that are trading. It's the amount of shares and contracts that are being traded. All right. It's not how many people are trading. It's the amount of shares and contracts that are being traded. So if price is dropping, but the selling volume is decreasing, that's letting me know that the sellers are stepping out. So when it gets to this zone, I should expect that it's going to go ahead and stop, kind of consolidate a little bit. All right. So when I'm looking at in the consolidation period, for me to say, oh, this is an institutional setup, I want to make sure that that volume is low. Why is that? We can just take it on right back over here to what we was talking about when we were looking at these 4 phases. The volume should be low because they kicking you out. Us, because I'm included in the kickouts. I don't get to play with them either, okay? They're kicking us out. They're doing it very stealthily to make you get annoyed with it, to make you think, oh man, this isn't a tradable stock. Yes, it is. That's why they're over there accumulating their position. Yeah, is patience. So I definitely want to see that it has low volume while it's basing. When it breaks out of the base, the consolidation, it needs to have high volume for me to continue to think that, oh, this is an institutional setup. Why is that? Well, we just talked about that's big money. That's big money. Just pushed it out that range. We didn't do it. They did, right? The market movers did. With the market movers comes big trades, meaning that on the break, it should be a high volume break. It doesn't matter if it's breaking to the upside, the downside, whatever. It just needs to be high volume so that I know that that was institutional. Because you could load up, I read somewhere, I don't know if it's true, I'm not a math person, but I'm gonna go with it. But I read somewhere that you could add up all the retail traders and the money that we put in the market and put it up against the institutional traders, and we don't even shine a light. All right. So please believe that a high volume break ain't got nothing to do with you. It don't have nothing to do with you. Okay. Now, here's where it gets real. When price starts to retrace. When price starts to retrace, that's where it gets real. That's where you pay the most attention. In this example here, we see that as price was retracing, as it was going back up to retest this demand, the volume decreased. It's the same thing as on the drop, right? When I saw the volume decreasing as it was dropping, I was like, oh snap, the sellers are stepping away. They're not really selling that much, selling off shares and contracts that much anymore. And as it's retracing and it's decreasing, I'm like, oh snap, the buyers, because buyers push price up, right? Sellers push price down. We got that. The buyers, y'all really ain't buying. It's weak buying on the way up, letting me give me a very great indication that this is going to reject when it comes back up here. And that is what it did. And look here, as it rejected from the zone, the volume was increasing, letting me know that, yep. This is what we want. We want this here. All right. And it's the exact opposite of it if we're looking at or the same thing if we're looking at the rally-based rally. Instead of a drop-based drop, the rally-based rally, I still want to make sure that when it's consolidating, the volume is low. I still want to make sure that when it breaks out of the consolidation that the volume is high. And I'm still paying attention to the volume when it's retracing. Now, let's say that this volume, as it was pulling back, was increasing. Guess what? I'm not going to think that the trend is that the initial trend, which in this case, the initial trend was a rally. I'm not going to think that the initial trend is going to continue. I'm going to think that the initial trend is about to reverse. Why is that? Because the volume increased as it was going up, letting me know that the buyers were stepping in. They were more than likely, high probability going to push price back above and reverse it, all right? So instead of a drop-based drop, it'd be a drop-based rally, right? Or here, instead of a rally-based rally, for this example, we have a rally base and then a drop, all right? The reversal of it. So the volume just lets you know it all. So those are the first two things I do want to say, like paying attention to the 4 phases. That's the best indication, especially on the higher time frames. You have to know what phase of the market are we in on the weekly at least. Well, not even at least. On the weekly and the daily and the weekly time frame, you have to know what phase are we in. Meaning, is it phase 1 accumulation, phase 2 uptrend, phase 3 distribution, or phase 4 the drop, downtrend, right? You have to know what phase are we in up top, because then you know how to play it down below. So right now we know that we're in an uptrend. I'm sticking with it. We know that we were making higher highs and higher lows since November 2022. The market has been making higher highs and higher lows. All right. So when I go down to the lower time frame, when I see a low, well, no, we're gonna get there. All right, so paying attention to the supply and demand. The next thing that we want to do is pay attention to the trend. All right, you must pay attention to the trend, and that is being are we making higher highs and higher lows, which is an uptrend, or lower highs and lower lows, which is a downtrend. All right, we only got 2 trends, up or down. That's it. That's all. Now, when we're looking at those trends and we start to really dissect that, you need to understand that there's 3 different levels, I guess I'll say, of a trend. You're going to have your primary trend, which is on your higher time frames. Your secondary trend is that corrective move, is the pullback, the retracement, whatever, right? Because even if we're in a uptrend, there's still a point where price will make a higher high and then pull back down to make a higher low, right? That's the secondary trend, which is best to mark that off on your charts on we'll say the 1 to the 4 hour time frame in there. Then you're going to have your minor trend, which is for on the lower time frame, like the hour and the 30-minute and below, we'll even say your minor trend. Now that primary trend, once you mark that on your chart, baby, that should stay there for some months. Okay. The secondary trend, once you mark that on your chart, that should stay there for a few weeks. Your minor trend, if I look at your chart and you don't got just like these trend lines all over the place, like sets of trend lines, and you seeing where price broke and started a new trend line and all that, you're wrong. You're wrong. The minor trend is just gets moved all the time, all right? Because that's what price is doing right now on a day trading level, a scalping level. We'll say it like that. Intraday. If y'all like that word, cool. So swing highs and swing lows, swing highs and swing lows. And I'm going to show y'all an indicator. I'm Fred Flintstone with it. I don't use too many indicators because they get in my way. It just gets in my way. I like to keep it simple. And I have found that the simpler the trade setup is for me, like Hey, usually that's when I make the most. The harder that setup is, if I, anyways, so let's get into here. So y'all have this here first to watch, and we're gonna start off with the swing low. Is that the same? Drop it this, what the heck? Anyway, so let's look here. All right, so there's a difference between highs and lows and swing high, swing lows. Stick with me, stick with me. You can do it. All right, so we see here that let's just ignore the labels for right now and follow me through price. So we can see here that price pushed from a low and it came up and it made a new high. Now, when it pulled back, it retraced, okay? This was a low. Again, ignore the labels for right now. It made a low. Okay. Now, when it came back to previous resistance, once price broke the previous resistance, we now look at this low as a swing low, letting us know like, oh, snap, yeah, the trend is changing. The trend has changed. You remember, we coming from a low down here. We're just going to say that this was a drop and then it accumulated and then started the uptrend. All right. So this low, until it broke this previous high, this was considered a low. All right. Now, I'm going to show y'all on the chart, of course, but let's start here. If price would have stopped here, it would have met resistance here. We would have considered this to be a high. This was our high. This was previous high over here, right? Like we would have looked at this as a high. And look how easy this trade setup is for you now. You already have a support level right down here. If you wanted to, if price rejected right here, it failed to break previous high probable chance that it's going to come back down to the previous low to here, right? And then our hope is that it'll continue on down. And so that would be a double bottom that plays out, right? But this is where you want to secure profit. This is where you want to secure profit. Because what I have found is what scares people the most about swing trading is knowing when to take profit. Secure the profit right here, okay? Because it's more than likely, especially up top, not gonna come here and then just blast through and go down here, all right? Because they gotta fake some people out. They gotta shake y'all out. They have to make liquidity, however you want to look at it, all right? So more than likely, you're gonna get that move down there. So just enter in again when it breaks until you build that resiliency in the capital. So, but anyways, we'll get there. But again, so when it broke, we look at this as a swing low. So I like to use the analogy of, let's all think about like if we're at a playground and we're on a swing. The way that, how do you build your momentum when you're on a swing? By kicking your leg under you, right? That's how that's what you do. Like you kind of leaning forward, you kick your leg under you, and then and then you kick it out over your head, in front of you, over your head, right? And the higher you kick your legs over your head, the higher you go on that swing. Ooh, 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 ooh. Okay. You gotta swing them legs down low, kick them out to go up high. Okay. So it's the same thing here for a swing low. You kicked your legs out above your head and you was able to push on up to the top of the bars. Right? So then price got here and it found another high because it doesn't just blast off and go up for eternity. If it did, we would all only need to show up to the market one day, right? So then it came down and guess what? This again is a low. Why? Because it did not come back down to previous supports. Because once we cross here, this was no longer support, right? Like if price is above your level, it's support. If price is below your level, it's resistance. And these key levels act as support and resistance. Why? Because all they do is buy and sell in the same places. History repeats itself in Wall Street Been Black. All they do is buy and sell in the same place. They're key levels. If price is under it, it was resistance. Guess what? It's above it now. It's support. Same level, just switch it up. All right. Anyway, so this is a low. This is a high. Why? Because it didn't come back to previous high. And we get it. We get it. We get it. We get it. On the way back down here to this previous support. And then here, And guess what? This became a swing low because it broke previous high. Came on up here and blasted off. So this is actually a beautiful place to look when you see a setup like this, to look to enter into a swing trade. When you catch it breaking the trend. Hello. Hello, hello. It broke the trend. That was a downtrend. That was a strong downtrend. We could say this was for 8 weeks. Then it broke. That's a swing trade entry. Simply from paying attention to the trend and when it changes with the swing highs and the swing lows. All right. So then we have another one here, and y'all will have this to stop and watch it on the video, just another visualization, but it's time to get on the chart. So once again, these are some long-term chart patterns that are the most high probable. I know a lot of people don't trade chart patterns. They kind of scoff at them. But I'm one that says that no pattern is validated until it plays out. So chart patterns and candlestick patterns don't mess me up. Because if I see let's talk about a candlestick pattern. So if I see a bullish engulfing, which is a 2 candlestick pattern, all right, here's where people mess up at. They enter on the 3rd candle. They're like, oh man, here's a bullish engulfing. This 3rd candle was bullish. It's time to get in. No, baby, that 3rd candle was the confirmation. You enter on the 4th. After that candle closed, after the confirmation candle closed, you enter on the 4th. People would like, let me say that again. Let me say that again, because I don't feel like I seen anybody say anything in the comments. That was a gem. Here's where people mess up at. If they see a bullish engulfing pattern, which is a 2 candlestick pattern, you have we'll just say a small bearish candle. And then the next day you have a very large bullish candle. That's a bullish engulfing. So then on the 3rd day, people enter the second that candle turns green. And they're like, bam, caught it. I'm in this trade. Guess what? You just messed up. You just messed up. That was the confirmation candle to the bullish engulfing. Because what is a bullish engulfing pattern tells us when we see that, right? That price is going to go up. The only way that I'm able to know is this bullish engulfing validated is if that 3rd candle closes higher. If it closes higher, y'all enter the second that 3rd candle turned green, baby, where was the close? Where was the close? Where was the close? Come back. If Monday was a small bearish candle, Tuesday was a large bullish candle, bam, bullish engulfing. Wednesday needs to close bullish for confirmation. Thursday, you get your butt in when it crosses the high of Wednesday because it's been confirmed. So for me, candlestick patterns and chart patterns ain't never messed me up because I'm cool being paid. Well, that's a hyperbole, but y'all know what I'm saying. Because of course, it's human nature. I've been impatient. Don't come up in my comments talking mess about what I said because I corrected it, and all I'm gonna do is pray for you. Amen. Okay. But they rarely mess me up because I understand that you need the confirmation. All right. So just a little rabbit hole there. So a head and shoulder, cup and handle, your triangles, whether it's ascending, descending, and your flags, whether it's bullish or bearish. Very high probable chart patterns. The double bottom and the double top, I know that's the easiest for y'all to spot. Unfortunately, they're not very high probable. Sorry. High probable indicators that we absolutely want to use, baby. Above all else, moving averages. Why? Because moving averages show us what the average price is. Baby, don't you want to make sure that you're on the right side of the trade? Moving average, come on now. If price been going up for the past 100 days, and then you get into the downside, child, moving averages, listen. Now, the 100, listen, me, I believe that the 20, the 50, the 100, and the 200 are integral. I use them on all time frames. The indicator that I use is the moving average ribbon because it has 4 moving averages on it at the same time. I use them all and they work for me for all. However, I will say that the 100, you absolutely want to go in there and pay attention to. Okay, you want to pay attention to that 100 because historically, this is a very strong level of support. The 100 moving average historically is a very strong level of support. The 200-day moving average, I feel, is equally as important because it's your yearly average. Correct me if I'm wrong, whether chat or if you're watching this on YouTube, I believe there's 252 days or 222 trading days in the market year. So that 200-day moving average is your yearly price. So I pay attention to those. When I look at the 20-day moving average, we have 5 days in a week, typically, right? That we can trade. So your 20-day average is your monthly moving average. Your 50-day moving average is your quarterly moving average. Okay, a little shy of 3 months, but if we break it down in there, it's your quarterly. The 100, a little shy of 6 months, but it's your half a year price. All right. You want to be able to look at it like that. Now, we know with the moving average crossovers, if the shorter time frame crosses above the longer time frame, that's bullish. If the shorter time frame crosses below the longer time frame, that's bearish. There is a multiple videos of moving averages here. If you're not well versed in them, ain't no shame, ain't no shame. Videos here on YouTube, go back and watch those. All right. MACD and RSI. I believe that they cannot be used without each other. They can't. That is my belief. And I have found that if you use them individually, using them together, you'll have a higher accuracy rate with your trade. And the reason being is because MACD is showing us the momentum behind price change, where RSI is showing us the speed behind price change. All right. So think about in a car. That car can't move without momentum and speed, right? Price can't move without momentum, which is us. We create the momentum. Well, the market movers, but you know what I'm saying. We create the momentum with our interest in it, right? And then the speed of the trade comes in by how, us running and get into that trade, right? So MACD and RSI should be used together. The Fibonacci retracement levels, the way that I chart when I'm charting the 6, I'm actually marking off the retracement levels, and I'd rather do it myself, but time is of the essence to some. So the Fibonacci retracement levels, lit. If you know anything about the Fibonacci sequence, or let me say it like this, if you are not well versed with Fibonacci sequence, not the Fibonacci levels like that we use as an indicator, but the Fibonacci sequence, I feel like you should definitely go learn about that, kind of look it up a little bit, because again, it just helps you understand, right? We don't want to memorize anything, we want to understand it. Because if you memorize something, I don't know, it's like these kids. It's like with kids, right? Like I feel like when they're learning addition first, like in kindergarten and stuff, they just memorizing it. And so it's like when they forget, they're kind of looking at you like 5 plus 3 is 17. No, it ain't, baby. No, it ain't. No, it ain't. But if you truly understand, and if they was really to break down math, right, it wouldn't be memorization, and they wouldn't need to ask anybody for help. It's just in them, right? So, don't know where that came from, but somebody needed to hear it. I got sidetracked. If you say 395, I'm a super chat you. I don't know what 395 is. The Fibonacci sequence though. So what that is the it's in nature, it's innate. They say like you see the Fib sequence in sunflowers and our faces. You see it in how they have grids set up, like on maps, right? Is the Fib sequence. And so it's like you take these numbers, it's no matter how you chop it up, no matter how you add them, subtract them, or whatever, it'll always come to 618. Whether it's 0.618, 6.18, 61.8, 618, that 618 is going to be somewhere up in there. And what the, let me put this chat down. Hold on. I was doing so good. 1 second. You'll see that number pop up. It's actually quite fascinating. And there's a video in the Discord, in the indicators tab, on how I broke down Fibonacci sequence, not necessarily the levels, but the sequence. And then Bollinger Bands, which is also another momentum indicator. It's the least high probable, that's why it's down there at the bottom. So how can we find some swings? Well, this first hour of class is what we just sat and we went through, like using chart patterns, understanding the supply and demand. Baby, that economic calendar. That's my second new thing. When y'all come in and y'all ask me on the day where that economic calendar clearly told you to go mind your business, and you ask me, hey, Coach A, what you think about SPY? I don't think nothing. CPI is coming out in 3 hours. What you think? Shoot. That economic calendar, okay, you need to know what it is. That's that, baby, you should know exactly what day. They give it to you. They literally are telling you by putting out this economic calendar, hey, we got CPI, which is consumer price index, which is telling us how much we spend in America, right? And this day, and then PPI the next day, which is the producer price index, how much these companies spend to give it to us, right? They're literally telling you, we got this big news coming out that's gonna let us know how our economy is gonna keep moving. This is when we plan to show up. But oh, okay, all right. If nothing is on that calendar, I'm off. I'm not trading. I mean, you also want to factor in earnings. So this week, I had someone, and I realized what the source of frustration and my response was, is because people will come to any analyst, right, in the week of Amazon earnings and say, what do you think about Amazon? I think that I got into it 2 weeks ago. You? Or 2 months ago. You? Why is that? One, to swing trade because it's something that we're holding on to for more than a week, more than a month sometimes, if whatever the setup that you see is, right? But I understand that there's earnings that comes out every quarter, every 3 months. I'm looking for a contract that's after earnings, if I'm interested in holding it that long, right? If the setup is there. I'm not looking at a company the week that they have earnings, the week before they have earnings. Guess what? Because the premium is going to be higher. The Greeks are going to be crappier. And no matter if price goes up in the direction that you thought it was, you still not going to make what you thought you would. Because you came around too late. Right? Mergers and acquisitions will definitely get it. We've had a few classes with Dr. LaKenya with the healthcare sector, letting us know with that. And then use your resources for seasonality, preset screeners. Yeah, I don't know why I put et cetera, because that's all I could think about. It just looked good to put et cetera, I think. Those are the ones that I have, and I think this is the end of the presentation. Dang it. Oh, it is. Woo! All right, period. Let's go to the chart. And what I'm going to pull up is ES because, baby, I like to trade the futures. I love to trade the futures. ES is identical to SPY when the New York market is open. Blah, 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 blah. Fitty. Thank you. Oh, Fitty. Thank you. All right. So here lies the range that we're in. We have had this absolutely beautiful, beautiful, beautiful uptrend. I'm talking about this thing was gorgeous, 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 gorgeous since October. This push that we've had here, I could really backtrack. It's October, right? But I'm gonna we're gonna look here. This beautiful push that we had here since October, and this trend that we've had. Now, come on, mouse. All right. Now, the last major retracement that we had, because remember what I said, like once we get out of a zone, I'm cool on it. Like I don't feel the need to have it charted down there. What the heck? I don't feel to have the need to have price all the way charted down here. We can see, and I'm on the daily, that price found some support in here, and it pulled back and it retraced right here. It held this level here. Love it, love it, love it. Okay. This is where y'all bought. Y'all bought in here the last major time and pushed price up. And then obviously we know the all-time high. The all-time highs that we had here. All right. So this is what I have marked off as the supply area where there's resistance. This is where they consolidated price at for a few weeks here at highs. And then down here, the last place that they bought is what I marked off as my demand zone. Now you can look at some charts. It's not a charting class, but for some, because I understand that support and resistance is a singular point, right? A candlestick only has one high and one low. So support and resistance is a singular point. Supply and demand is an entire range, all right? And again, we understand that in these supply and demand ranges, that's where they're accumulating and distributing. So for me, I understand that this single level up here was the resistance level. That's the highest that ES got to, which is the futures chart for the S&P 500, the futures version of SPY, which is an ETF for the S&P 500. So this is where it consolidated at. We stayed in this range. Look how many times they tricked y'all, making it think it was going to go up or come down. It finally broke out of this distribution, right? And it broke. And oh my goodness, what are we getting right now? Is this the retest of the distribution of this of the supply zone? It is, it is, it is, it is, it is, it is, it is. Right? So that is I don't if I keep it marked on my chart for this class, we will go ahead and keep it marked on the chart. And so then you might say, okay, well, if you have that marked off for your supply, then how would you mark it off for your demand? Baby, the same thing. I'm gonna go look for where that consolidated price down here at these lows. Now this one is, I'm just gonna put it here since this is where I have the level marked off. And just go ahead and put it there. Technically that, but we're gonna keep it cute, keep it here. Oh my goodness, y'all, and I didn't even force that. It just happened that way. It just is. Okay, look how that retested right there with high volume. And as it's pulling back up, all right, okay, cool. So we have our supply zone, we have our demand zone. Now, of course, this trend was broken, but it ain't been retested yet. So I like to keep my trend lines there. But remember, we still need these retracement levels. But look how easily it is to do so. We're gonna just mark off the bottom of the consolidation at highs. Then we're gonna mark off top from the consolidation at the lows. Where did price break out of the accumulation range, or the accumulation down here at the demand zone, right? And where did price fall out of at the supply zone, right? So it's fairly simple to mark it off. Now, from me looking here, just because of this one day where we can see that the buyer stepped in right there, you pinching pennies at this point, if that's what it's called, but I'd go ahead and move that there. Because wicks are tricks. And if price does reject back down, I want to have realistic goals that this is where I'd stop myself out, because the buyer has stepped in. This lower wick is telling me that it came down to this demand zone and buyer stepped in. And then these candles never even came down here. So this is like, if price rejected and came back down, this is where I stop myself out at. I'd never come back down here, where historically all they did was push price up. And this is going back to in February, right? Historically, all this is where buyers stepped in at every time, right? So I'd never continue to short ES down below here. No thanks. This is a demand zone. It's a little backwards, all right? And those are my 6 lines. That's charting the 6 for me, and it carries me through all the way down to the lower time frame. Now, let me be real about it. Because that trend, actually, let's put that back. Okay, this is now the trend. It failed to continue to make higher highs and higher lows. All right. Now, mind you, that's a rising wedge that it was making. So the writing was on the wall. It was in a distribution phase. Nothing goes up forever. It was a rising wedge chart pattern. It did a double top candles or double top chart pattern as well, right? Now, my trend line, baby, I ain't gonna hold you. Sometimes, like, let me be transparent. Sometimes that trend line be getting me. It's like, cause it's consolidating in here, right? So I just want the most touches and I feel like I'm okay with that. Just let me get the most touches, or if the best that I can do is mark off this support, then I'm kind of straight with that because I can do it. Actually, I don't like that. And then this is what I'm gonna do. I'm gonna go to the 4 hour actually and see if I can't mark the trend line off better this way. And if I have a difficult time marking off a trend line, guess what? Price is consolidating. Duh. But so we have that. Oh, look how this helped me even more. We were making the lower highs and the lower lows, and then we stopped. So that's actually not even my trend currently. This is. It broke that and started to make higher highs and higher lows. I want the most touches. So we're gonna put this here. And the resistance, I just backtrack it. Don't ever be confused. These lines aren't glue, right? So we got highs, 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 broke that high, broke that. All right. Now let's see when we go back to the daily. A possible chart pattern should be somewhat forming, or not even somewhat. A possible chart pattern should be forming for you. So where you see it. Or even if I did it like this for you. Now, here's what I mean by if you know what I run through the scenarios, child. When I say I will sit here and I will run through the scenarios and write them down because then I'm not surprised. But here's the thing. I also don't I don't put too many eggs in my basket. I don't put too much on me, right? I don't need to look at a bunch of charts to do what I need to do. So anyways, so I see what could possibly be a head and shoulder from here, left shoulder, head, right shoulder, if it rejects, and even a bear flag forming. If it does reject here and it comes back down, I wouldn't be nervous. I would say, oh snap, what did we just talk about with those accumulation phases and why they retrace? You need to come back for the rest of your orders, which would then show me a double bottom in the demand zone as it worked its way back up. That, oh my gosh, who is this in the Discord? Jesus. Okay, all right. So that's one thing I see. So it wouldn't skip, like if this bear flag does play out and it does break below here, we're aware historically that we're most likely going to return to this 5,000 if we lose the 5,000 down to the 4,950 range, right? And then that's when I'm looking, the very first thing that I'm looking for, again, is do we hold and make a second bottom? If I see it start to break back up and it breaks back over the 5,000, I'm going to assume that this double bottom is going to play out. And this is when we get this push here, right? That's one scenario. But baby, if it gets into this demand zone, and especially if it fails to hold this, child, this is now support or this is now resistance. If price comes down here, it is what it is. We're traders. We can capitalize in both directions, right? Like that would that would now turn into resistance for me. It's still a level I need to pay attention to, but I just understand that now it is resistance. That this would now be my supply zone, all right? That I'm looking at because price is under it. That's the only time that my brain is gonna flip is if we fail to hold. Hold on. If we fail to hold this 48.68, that'd be the only time that my brain then flips into, oh, okay, well, we're not in a bull market anymore. We are on our way. We are on our way down. That distribution phase and the drop was not just a pullback, but it was the start of the bear market. Anywho, so that is when my brain would start to go, okay, well, we're bearish. Let me observe what I'm doing. Let me get into these long-term puts. Okay. Now, if we do break above here, right? Oh, wow. Look, this is the perfect example. This is the perfect example. So a morning star pattern, a morning star pattern. So we had a morning star pattern right here, which is a 3 candlestick pattern. This fourth candle was the confirmation of, oh, okay. And it closed higher, right? Because we had the long bearish candle, the doji that gap down, spinning top doji, whatever, that gap down, closed lower. The bullish candle that gapped up and closed inside the body of the first candle, right? Morning star, perfect, 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 right there. The confirmation candle closed higher, bad, 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 bad. I still need that fourth candle before I enter. I know a lot of people. I know people who said, bam, we bullish. Look at this bullish day. Look at that volume. Look at that volume. Look at how, as it's pulling back up, once it started to pull back up, and I'll just mark off a line down here. I'm not creating anything. I'm not putting out any fear, and I'm not saying anything. I'm showing you how I look at it in both ways, because I won't be surprised by anything. Look at this volume, and this is when price started to push back up. It ain't nothing compared to the volume when price was dropping. That alone is showing you that that is a low volume retracement. Now, if it blasts through, it breaks through the resistance trend line, who am I to not go with the momentum? But I see what I see, and I'm going to be patient enough to wait. All right. So we got that. Now, let's turn on these moving averages. And we're going to look at the moving averages starting down here too in the demand zone. So when it pushed up into the supply and when it broke and how it's holding it all now. Oh, I turned off. I just got the 20 and 50 pulled up, I think. Thanks for my flowers. Now, these moving averages, because it is the average price, is a beautiful way to act as support and resistance. Did I start this recording again? I think I did. I did. Okay. It's a beautiful way to act as support and resistance. All right. So the 20 is yellow. The 50 is blue. The 100 is purple and the 200 is red. Now, someone out there might ask, are you using the simple moving average or the exponential moving average? Let's talk about it. The exponential moving average came around later, years later, because someone said, this isn't showing me, this isn't reacting to recent price movement quick enough for me, to recent price changes quick enough. So let's make the exponential moving average. So what they did is they went into the calculation for the simple moving average, right? They readjusted the calculation on it to make it hold more weight to recent price movement. So if you're a swing trader, I mean, do whatever, right? Do your due diligence. But if you're a swing trader, common sense just tells me that I want the average, the simple moving average, right? I don't want to use the exponential, the EMA, that's reacting to recent price changes quicker, right? I'm in here for the long game, right? Long time, not a good time, right? So to me, the EMA is for good time trading. The SMA is for long time trading. Do with that as you will. So we got this beautiful morning star down here. Baby, morning stars and evening stars are the candlestick patterns that you are most likely to see against trend lines. So again, if you know what you expect to see there, it's quicker to spot it. So we got this beautiful morning star here. It's curving up, right? You get this break over the 200 and the 20 MA. To me, once it crossed all these barriers, meaning all these resistance levels that the average was creating, because at this point in time, the average price was no higher than about 44.29. right? So once it crossed all these barriers, it's go time. It was go time. It was go time. And then you could then use your 20 MA. And if I turned on the 9, it really used the 9 as support, right? Now, to me, the order that I look at the market in is supply and demand. Then I pay attention to the trend. Then I focus in on price action. And then I'm going to throw up an indicator for final confirmation. All right. So we didn't quite need that. But to have this confirmation of, oh, snap, this broke above all these averages, while we also have MACD down below. You can see that's right when it crossed over and diverged in positive territories with higher volume. Yay, it was game time. This is a swing that we like. So if we're using the averages to get us into the trade, right, and it's holding this 20 MA as support this whole time, when price loses the 20 MA, the second it closes it, when you're a swing trader, right, it's different than when you're day trading and you're like, oh, it closed below the 20 MA. Let me wait on confirmation. No, baby. When you swing trading, the second when it closes under that 20 MA, you're out. You're out. This is up top. You're out. It held that average for 6 months. You're out. Get out. Get out. Take the profit. Get out. Get out. Get out. Get out. Get out. Okay. Take your profit and get out. Don't wait to see a bearish crossover. No. It held this. And honestly, the second, well, I ain't gonna say that. It closed below it. It hasn't, and then put it in perspective and say it hasn't been below the 20 MA since November 2000 or 2023. So in April 4th, 2024, maybe you should exit your swing trade. Now I know we're looking at a futures chart, but that's what I pulled up. It was a clear chart. And we'll look at, I'll take a ticker request at the end. We'll chart it, look at it, swing entry, boom, 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 all that. All right. So it's the alignment of it. Now, something that I absolutely pay attention to as well is the direction that the 200 MA is turning. And let me show you what I mean by that. The 200 MA is my red one. So we can see here that the 200 MA was slanted down, and price was definitely down below. But in here, when you can see that it started to curve up, right? It's showing us, hey, it's very possible that this trend is about to change. And look what we got. It never did start to turn back down. Even when price came below it, it still was flowing up. The yearly average was to the upside. It's not necessarily just flowing straight up anymore. Huh? Looks like it's kind of about to kind of plane a little bit there, right? They messing with us a little bit. So we want to do that. And then using them all together, right? Using the fact that it's in a supply zone. It broke a 6 month, or we're just going to go ahead and say a 2-year support trend line at the supply zone. There was a double top at the supply zone, and then it broke the trend line. There's moving average, bearish moving average crossovers. Price came below the 20, the 50, and the 100. It's holding the 100 right now. This could be an ABCD pattern. Well, honestly, because it's A, B, C, D. Let me mind my business. All right. So we got that. All right. So now I'm going to pause the recording, and I want to give y'all a chance to ask questions and throw in a ticker request because we'll chart that. So I'm going to pause the recording to answer y'all's questions. I don't want the video to be too long on YouTube. All right, so we got a ticker request, and we're going to go through and do a top-down analysis of Home Depot. So I'm going to start off. First thing I'm going to do, child, is mark off my zones because I go in order. And we clearly see that this was a support levels here, that we got multiple touches here. Now I came to the weekly. That's my preference. And I very much so color code my chart, so y'all bear with me here, because I don't want to be confused when I go back. All right, so I'm gonna start off historically, right? Like I will literally mark my chart historically first, so like this, and then I expand it. So right now I'm looking at Home Depot in 2021. All right, so I see this support where it was previously resistance over here and turned into the support. So what I'm doing is the first time that it touched and it held here, we got this beautiful little morning star over here. This is where it rejected at first. Cool, that's that first high. That's that first swing high, right? Remember we talked about that, those swing highs? So I'm gonna put a level there. But remember, I'm understanding that that's a retracement level, right? Because what did it do? Then it pulled back and made a low, but this low turned into a swing high because it broke and it made a new high, right? So this is a great signal for us right here that it found that it made a higher low, right? That higher low was more than likely going to turn into a swing low. And then from there, I can see that this is where it topped out at. So that's my supply before it came all the way back down to bingo, demand, right? That's all price does is move back and forth between supply and demand until it breaks out of that supply and demand range and creates a new one. Now, when I'm doing this, something that I want to show y'all, I'll go ahead and mark it and then I'll show y'all why I did. And this goes for the, because I know it can be confusing to people when they're really learning to understand the difference between supply and demand, which is also an order block, okay? If you my smart money people, whatever. And then the support and resistance, so marking the squares will help you more, right? We see technically, right? Like I know where I marked my level at because that's where it was holding the candles the most. But look how they were buying, because they definitely bought at this low right here too, right? They were buying. Now, if I extended this and we went back to 2020, oh snap, y'all. At this point, when it was here, this was the supply zone. And let's flip the color, right? This was the supply zone. And then it went back. And what did it do? It pulled back and it retested it, held it as support. So it then flipped it into my demand zone. Price is now, oops, above here. This is now my demand zone, right? And this was in 2021, respecting it in 2022. And look at this, respecting this retracement level, December 2022, 2023, January 2024, April 2024. You got to go up top and find these 6 levels. So when I'm saying chart to 6, you got to go up top and find these 6 levels. Now I know it's 1, 2, 3, 4 on here, but whatever. Right? You got to go find those, yeah, up top. Because they get respected over and over. Sorry, I was looking at something. So we have this level here. And now that I'm looking at the rest of it, wicks are tricks, right? I'm gonna go ahead and cut these off with the newer data that we have, because this is 2 years later, almost 3 years later. I understand. I want to go ahead and cut these wicks off and look how it respects that again in late 2023. And then look how that's beautifully where that held it these last 3 weeks. It's catching bodies and wicks right there on this level, the 333, right? Loves it. Now, you can also mark off the gap to help you find the retracement level. When you're here, especially when you're on the weekly and you can easily spot this gap, that means that was a very large break. That was $15 down in 1 week, right? So we're gonna go from the close to the open, from the close of the last candle to the open of the next. And since this was, it gapped down originally right there, right? We're automatically looking at that saying, oh, okay, that was a bearish order block, a supply zone, whatever you want to call it. And we can see in here from the 340, we'll just say from 333 to 346, that seller showed up. Because mind you, I'm on the weekly, right? All they did was sell off there. So if price, oh snap, makes a swing low, because it kind of breaks up here, all we can do is assume that it's coming to that 419, 420, we'll say. Now, one thing I'm missing is my trend line, okay? We must have the trend. It's just depending where you want to start it. You splitting it. You can start it this October 2023, but that's kind of in. We put it like this, right? Now, I do think that when you're marking off your primary trend line, going to like the 4-hour and the daily is best to really help you. So this trend from our demand zone down here, right? On up here, we can see where price broke. So this would have been a great swing entry. This would have been a fantastical swing entry. All right. Now I want to show y'all how you could have known about right here. I'm going to point this out, like about right in here, that price was going to fail to hold this trend line. And it's simply from paying attention to the range of the uptrend, or we'll say of the trend as it's pushing up. So let me get the arrow out. Is the arrow here? How do I forget where the arrow is every time? All right. So this first push up was from, and I'm just rounding numbers, okay? This first push up was from 280, and then it topped out here at 354, and then pulled back to 340. So it pulled back about $15. But from 380 or 280 to 354, I can't do math. Somebody will put it in the chat. That's a lot of dollars up, all right? And then the next time that it pushed up, it did it from this rounding, 350 to the 385. So about $55 push up. But when it did it this time, it did it from about 373 to 397. The push-ups were decreasing. So when this came back down, that was a great indication of, oh snap, price not staying up. Price not going to hold this trend line. It shall probably fall. And then if we're looking at the volume, what is this? We get this very large volume spike. And then as price was pushing up, it was low volume pull back up. But it sure did come in when it was dropping, right? And it's always helpful. I think I saw someone in the chat put that too. Put a line down here at the volume so that you can visually see, oh snap, this bearish volume was way higher than it was when they were pushing price up. It was not going to stay up there at the top, right? Y'all see that? Put a comment in the chat, or if you're watching this recorded version on YouTube, put a comment if y'all can see that, how even paying attention to the how far it pushed up after it retraces and retests the trend line really will help you see when that trend is kind of coming to an end. Y'all see that? Let me know. All right, so we got this. Let me go back to the weekly because we still need one more retracement level in there. I was just seeing how I wanted to mark it. And since we're here on the weekly, this is several weeks, right? We got about 3 weeks that it stayed in here. And then when I look, I'm holding this cursor here and I look to the left and I see gaps where it just kept gapping down here. I feel cool to go ahead and put like a retracement level in here. But I like to mark mine off for myself. Now, instead of doing that, or if I'm just like all the way like, pull up the Fibonacci retracement. Okay. So we're gonna start it at the top, drag it down to the bottom that you already have marked. Okay, and then I should have dragged that across. And let's observe. All right. So we have the golden ratio in here. So what I chose to mark off, right, is right here at in the golden ratio, the 0.5. And my level's a little bit in between there. I still like where I have it. We got the 0.5 and the 0.618. So I feel I would go ahead and just obviously put it at the 0.618. Put my level there. And I can see, obviously, it's Fibonacci, right? I can understand why this is the level down there. And so that helped me tighten that up. But I'm still going to keep this gap marked off here. I'm still going to keep that gap marked off. And then we have the 0.5 right in here where this candle closed, but I wouldn't want to enter until it closed this gap anyway. So yeah, I'm going to keep that there. I'm not going to let the indicator rule me, right? Because what I marked off is what I feel comfortable with. That's why I marked it off, meaning that I'm going to have higher, I'm going to do better trading my levels, what I saw, what I interpreted. All right. So we got this, and let me turn that off because we kind of got a lot going on. So we have our 6 marked off there. We come down here, and to me, this too easy because we understand prices has to return to the trend. Duh. Okay. And then I feel like since this is where it went on and rejected, okay, because it's obviously going to get back to this 396. Y'all know how market movers do. It'll get back here, cut those wicks off because wicks are tricks, and we're going to go ahead and put a level at the 395.38 as well. And if I'm looking historically, 2021, child, if that ain't the neckline of the double top that made it come on down to 265 in the first place. Amen. Praise his name. Confluence. From 4 years ago, 3 years ago, I can't do math. I love it. All right. So for me, I would be looking, my safety would be above this 361. I want a weekly close, not a daily. I need to see that the week closed above 361. And I'm okay being patient. Now, here's some things that I automatically see when I'm looking on the daily. This did, come on now, y'all. Come on now, y'all. Because on the cool, if this is what I marked off down here, right? I understand, like, overall from the weekly, that's what that was. We did this inverted head and shoulder down here, and it pushed its way on up here, right? We see that this is support, and it pushed back down here, and it held this as support, right? Meaning, and we see that, we see that price accumulated right there. Hold on, it consolidated right there, but because it pushed to the upside, I understand that it was accumulation, right? So I'm gonna mark off the highs and the lows of this range right here. I'm gonna mark this range off. And I just bet you, if we drag this across, my gosh, look at that. My gosh. Let's just keep going, just for the sake of. My gosh. My gosh. Right? We love to see that. So this green demand zone. Y'all, guess what happened when it broke out this demand zone? What do we see? What do we see? We see a high volume break. It did a high volume break. What? There we go. It did a high volume break out of the consolidation. Oh, snap. Is this what we learned in the first hour? What we want to look for? Oh, snap. So is Alexandria going to automatically get in? No. Why? Pending order is still down here. They couldn't release them all at once. I'm patient enough to wait. So at demand zones, what type of chart patterns do we expect to see? So if I'm telling myself, I understand that it has to retrace back down here. So I'm going to wait. But it's pushing up, right? And it looks like it's probably going to do a 3 gap up pattern, meaning that we got 1 gap. It'll gap up another time, give us the 2nd gap, gap up another time, give us the 3rd gap. And the 4th candle start the reversal. Well, if it reverses, I guess they're coming back for their orders. Ew, maybe we'd be looking for a double bottom out of here. Isn't that the same scenario that we saw set up when we were looking at ES and SPY, when we were looking at the whole market? Yeah. If we went and we looked at most of our charts, would they be this setup? Yeah. Light bulbs just go off for anyone?